Welcome to Market Monday from the investment team in the trust department at the First National Bank. Starting things off with the economy, like we typically do, this morning we got an extremely hot report on retail sales. That came in at 0.7% when it was expected to come in at 0.4%. And what that tells us is, consumer spending is more robust than we had considered before. And that means, with consumer spending being about 2/3 of GDP growth, that means that GDP is likely going to be higher than what prior expectations were as well. We're going to keep our eye on that. That's coming next week. We'll talk about that in a minute. We get information later in the week on the real estate market. We'll get, industrial production and capacity utilization. And here's a key one, the Beige Book from the Federal Reserve, which is a survey of, different economic regions around the United States that tells us, what are the business conditions like in those regions and what the Fed is seeing there. That's going to inform their thinking about whether they really want to start considering cutting rates or whether they think they need to keep them where they are, or perhaps even, as some have argued, start to hike them again, even though the expectation is for cuts. Going forward, we'll get labor market information and the leading index, which is expected to show a slight decline. That telegraphs that the market at some point is viewing a shrinking economy, a recession, as a real possibility. That index does have some predictive power, so we watch that carefully. We'll get the Purchasing Managers Index, which is essentially a sentiment indicator. We'll get more real estate, durable goods. That gives insight into the demand situation. Are these numbers coming in? First of all, are they growing? Yes, it looks like the expectation is for a pretty significant growth here, more than 2 times the prior reading. But we'll see what happens here, and we think these numbers are going to probably come in even hotter than expected. GDP is expected to come in at 2%, but again, that expectation is probably low when we are considering all of these other reports that have been coming out that suggest both economic growth and inflation remain, stubbornly high. Income and spending we'll get, and then the core deflator, which is the Fed's preferred inflation gauge, is expected to show 2.7%. We'll round things out at the end of the couple weeks with the University of Michigan Sentiment Index. And let's go to the S&P 500, which has been in a bullish run since late October of last year, and it's been doing nothing but go up until the past few weeks when it started to trickle down. But this isn't a big magnitude decline. It's about 3.5% at this point, and we think there are a number of things going on here. Rates are showing that they're stronger and likely to remain higher for longer. The economic data is coming out that suggests the same thing. And then you've got a new war, or at least a new chapter in the war, going on in the Middle East that has markets potentially a little bit spooked. And, we'll be watching those events. But ultimately, there's an underlying narrative that's been driving this thing higher, in our opinion. And let's go into it. So here we have the Consumer Price Index, and consumer prices are well off of their height in terms of growth rates. It's only about 3.5% as of the last reading, which was just a couple of days ago last week. And then we have the Producer Price Index coming in at 1.9. Now, what does that mean? So let's talk about corporate margins. If CPI is a proxy for sales prices and how they're rising, and this PPI is a proxy for input costs and how they're rising, you can clearly see that with the Consumer Price Index outpacing the Producer Price Index, corporations are likely getting better margins. And now we see on retail sales coming in higher than expected, and actually at the most robust level it's been since September of last year, and then potentially as far back as the very end of 2022. So with the purchasing going on, consumer spending as a proxy, or proxied by this, we see kind of a trifecta of things that are leading toward better earnings expectations, and better earnings expectations ultimately should drive stock prices higher. So it does make a little bit more sense in that context, what's been going on here, despite all the bad news. Now, we don't know exactly what's going to happen with this little pullback that we're in right now, or whether that remains little. However, the odds don't favor this thing continuing down at a rapid pace. Going into treasuries. The treasury curve has shifted pretty markedly higher again, and now we're looking at 1-year paper that's over 5%, 5-year paper is 4.65, and 10 years 4.63. So the curve is relatively flat once you get out there past, say, 5 years. However, that has important implications, because baked into those rates, if we're looking at a rate like this, the only risk in holding treasury bonds is inflation risk, the risk that your purchasing power declines over time, and the payments don't make up for it. So bond investors, who are among the most sophisticated and well-heeled investors in the ecosystem, are at a minimum wanting to break even with inflation when they look at the yields that they're willing to purchase on U.S. Treasuries. So that's typically called duration risk if you see it in other places, and it just relates to tying money up for long periods of time while inflation is eating up at your purchasing power on that. But with that said, this is a strong argument that the market itself and its most sophisticated participants see these inflationary conditions that we're in continuing for the foreseeable future. And as a result of that, we can make our assumptions and say, well, we're expecting things to be a little bit hotter from an inflation perspective over a longer term. And why would that be? Well, there are geopolitical structures that were in place under the globalism that was going on, in the 90s and in the early 2000s and in the 10s, that has abruptly turned on its heel and moved toward great power competition. And when everybody's collaborating and cooperating, it's really easy for inflation to be brought under control, because everybody can specialize in doing what they want and what they're best at in terms of geographically, and as a result, everybody kind of gets the best of everything, and the efficiency is going up under that circumstance. So when there's great power competition, everybody has to do everything themselves, and that's an inflationary force. So we see, until things change at the global scale, this inflationary type regime that's being telegraphed by the yield curve potentially is going to continue indefinitely, with a series of kind of ups and downs, but we're not so sure that we're going to see that 2% inflation rate coming back anytime soon. Certainly the bond market doesn't see that. Corporate yields are great. We're looking at paper that's well above 5% across the whole yield curve. 5.6, 5% at 3 years. We're getting 5.4 at 10. So all of this bodes well for investors who are using fixed income either to potentially live on in retirement and take the bond coupon payments, or those who are using bond positions to reduce the overall risk profile of their portfolios, potentially, are getting paid a lot more to do that. So this is a good situation. And we'll close here. This is a rough-looking day. There was just news about this conflict over in the Middle East, which might be driving things. But in the meantime, regardless of whatever is going on in the news, regardless of whatever is going on with the economic reports, we have a long-term plan that's set in advance, and it doesn't pay to deviate from that plan and change long-term plans based on short-term events. So either way, we're going to look at this as, we're still sticking to the plan. And if you have questions about the plan, if you have questions about the economy or the markets that this hasn't addressed, feel free to reach out to us. Hope you found this video useful. Thanks and have a great day.